Okay. Hi. So this is our group's ACT 301 final presentation, and we're doing topic number 7, regulation versus climate change in California. And our group members are Justin Jin, Ayush Bose, Aurelio Morales, Cesar Carreon, and Phung. So here's the agenda. So we'll mostly be talking about the regulation versus climate change problem in 5 different subjects. So why hasn't the Prop 103 rate regulation been able to deal with the California's wildfire coverage problem? And number 2, what are the consequences of the expansion of the FAIR plan? Number 3, what solutions have been proposed? And number 4, why haven't they been successful? Number 5, why can't the primary market use similar tactics as the reinsurance market? So first, I'll introduce some of the current problems in California insurance industry. So there's the Prop 103 passed in 1988. There's difficulty in increasing coverage to meet market needs. There's also the new exposure to wildfires and climate change. And lastly, there's increased costs for insurance companies. So I'll talk about these more in detail in just a second here. So here comes the question, why hasn't this version of the rate regulation been able to deal with the problem? And the version of rate regulation we're talking about is the rate regulation as proposed in Prop 103. So the Prop 103 introduces what's known as a prior approval regulatory system. What it means is that it requires prior approval for insurance commissioners of all of the insurance commissioners. So insurance commissioners must first approve a rate applied by an insurer before an insurer can implement the property and casualty insurance rates. So what that means is that the insurer must get the approval of the insurance commissioner before they can use the current rate. And they also introduce an idea of interveners who are rate filling professionals, and they represents the interests of the consumer. And if they show significant um, involvement in the process, they're able to recover their expenses, including cost or attorney costs. So the interveners allows the public participation in this process. So benefits of Prop 103. So yeah, as I said, public participation in the administrative process for setting the insurance rates, and has saved Californians billions of dollars in premiums by having these rates get approved first before they can be used. And lastly, helps maintain a solvent market and that's able to pay the consumers' claims. By having these approvals necessary, so the insurance commissioners are able to regulate them so that they are not issuing rates that's going to be unaffordable, or issuing rates that are way too expensive. So why isn't Prop 103 working? One of the big reason is the recent problem in climate change. So recently, if you haven't heard on the news yet, California has been getting a lot of large wildfires. And what does this mean? It means that a lot of the homes are going to need their insurance coverage. So as a wildfire is classified as a catastrophic event. So that means when each home gets destroyed and needs their insurance coverage, that the insurance company have to first get those rates approved and check that they're adequate. So that becomes a difficult and time-consuming task. So and the related cost of the catastrophe reinsurance coverage gets expensive when so many homes are affected all at the same time. And it's difficult for them to achieve rates adequate to keep up within the states. And that is why Prop 103 hasn't been working. And now I'll introduce the next part, and that is what are the consequences of the expansion of the FAIR plan.
Hey, my name is Ayush, and today let's talk about the consequences of the expansion of the FAIR plan. So let's start with the basic overview of what the FAIR plan is. So basically, the FAIR plan is just an insurance program that has been designed for property owners who that reside in like high risk areas or underserved areas, just to ensure that they have basic insurance for their property, which they would not have otherwise been able to get by another private insurer or any traditional place. So let's talk a little bit about the key features of the FAIR plan. The first is that they are a market of last resort, which means that if they're unable to get insurance from any other provider, they usually end up going to the FAIR plan just because no one else is willing to undertake such a big risk and provide them insurance for their property. Basic coverage. This basically means that the FAIR plan is super basic in its coverage, which means that they only cover, usually like in the state of California, usually it's only wildfires. They do not have coverage for anything else, such as liability insurance, theft, vandalism, or anything else. Risk pooling, this basically means that a lot of private insurance or insurance companies that provide insurance in the state have to contribute towards the FAIR plan. So this also helps the risk pool large variety of risks. So that means each individual person has to undertake only a small percentage of that risk. Next one is higher premiums, just because there's such a huge amount of risk involved with this particular plan, and they're willing to insure your property, which is very likely prone to like wildfires or damage, and you are more likely to claim that insurance. The premiums on these insurance are extremely high. Limited coverage options. This again ties back to basic coverage. So there are options for you to add on coverage to the basic wildfire coverage or destruction by wildfire, but they are super limited in what all you can add on. And again, each add-on increases the cost of your insurance plan. State oversight. This basically means that the government has a oversight or overlooks this program just to make sure that it is fair and everyone is getting access to this plan and it is working according to certain industry standards. So talking about the consequences, like any situation, it has both positive effects and negative effects. Let's start with the positive effects first. The first one is an increased access to coverage. This means that people who would not have been able to get access to coverage from any private insurer, now they have an option to get it from the FAIR plan. This basically means that there are more people actually getting insurance rather than people who are not. Next one is protection for vulnerable properties. A lot of private insurance would not be willing to insure a property which is more likely to be affected by wildfires. Like, say, for example, if your property is related close to a forest or large farmland, a lot of private insurance companies would not be willing to provide insurance for that. The next one is market stability. This just ensures that there is like fair competition for all of the insurance industry, and also it prevents the concentration of risk solely within like private insurers, and there is also state players. This also avoids disruptions in like broader insurance market due to like catastrophic events. The last one is state oversight. This just means that the state does play a role in it and like provides fair insurance programs for everyone, and also ensures interest rates are managed effectively. Now, the negative effects of the FAIR expansion are that there's a limited coverage option, as I mentioned before, that it will only cover safe wildfire damage and nothing else like liability or theft or vandalism. Higher premiums, just because there is a huge risk associated with this insurance, the premiums are also much higher, which leads me to my next point, which is potential affordability issues. Not everyone may be able to afford such high premiums, and then it becomes harder for more people to have access to insurance. And the last one is like an impact on private insurers. The FAIR plan pushes out private insurers who may charge a higher rate of interest, or people may be turned away from private insurers. Also, private insurers are forced to contribute to the FAIR plan, thus driving them out of the state. So let's talk about the effects on the insurance companies alone. The first one is regulatory hurdles and rate approval process. Like we mentioned in the case study, if there's an increase in the rate above 7%, there has to be a public hearing, and there has to be a state mandated hearing. This increases the number of hurdles that companies have to jump through. The approval process takes much longer. Thus, it becomes harder for them to actually carry out business in that state. Challenges and adequate rate adjustments. like in a state like California, where people are more likely to keep claiming wildfire damages. It becomes difficult to keep up with this demand if your interest rates are so low. Thus, it becomes harder for them to provide insurance. Insurers ceasing policy offering just because of the two aforementioned points of regulatory hurdles and challenges in adequate rate adjustments. Many private insurers are not willing to provide insurance and are just pulling out of the market just because of these challenges. This reduces the number of options for customers to choose certain insurance providers, and also the insurance providers are losing in market standing. Next one is impact on insurance market position. Like I mentioned, if they're moving out of the state, which means that they're losing their market share, losing their market position. And this also ties into the last point, which is financial implications. Having such large payouts at much lower interest rates is forcing them to take a hit on their own personal finances, reporting losses, and thus having an overall negative impact on the entire insurance companies, and they are being forced to move out of the state. So let's talk about State Farm, which is one of the largest insurance providers in the country. So they had they provided a statement to ABC News saying that historic increase in construction costs, outpacing inflation, rapidly growing catastrophe exposure, and a challenging reinsurance market is what drove them out of California. So as of now, they are stopping all new applications for any new homeowners, and they are not willing to provide insurance for them, but they will continue to serve existing customers till the end of their contracts and then reevaluate their position. They've also said that they've taken massive financial losses just because of the FAIR plan and their contributions to the homeowners insurance. They've decided to exit, reevaluate their position, hopefully improve their financial standing, and then maybe return depending on how the market conditions are at that time. So let's talk about the effect on customers. So for customers, they obviously have limited coverage options, which means that they cannot insure their house completely, which means they may have to go to have two insurance policies, just one which will cover, say, the wildfire damage, and one that would have all the other options. Higher premiums, which means that they're paying a lot more just to insure their house, and this puts a big strain on their personal finances and their ability to afford good insurance. There's also reduced access to comprehensive coverage. Like I said, since it's so limited, they're unable to create personalized plans to affect their own situation. This also ties into the ability to make like custom plans. Say, for example, you're staying in an apartment in downtown San Francisco or downtown Los Angeles. The chances of you being affected by a wildfire are much, much lower. But if you're part of the FAIR plan, you're just going to be covered by wildfire insurance, and then anything else is not covered. So this reduces your overall comprehensive coverage. Potential inconvenience, again, they're unable to find insurers who are willing to insure their homes and then tailor make those insurance plans to them. So they end up paying much higher rates again. And then the last one is risk of underinsurance. So many people may not be able to afford the entire plan, so they end up insuring for much, much, much lesser than what a potential loss could be. So again, this kind of defeats the purpose of insurance. So overall, what we've seen is to overall negative impact on both insurers and customers in the insurance industry just because of the FAIR plan. So I also have a quote from a consumer which was saying that carriers are very smart and they have very smart lawyers that usually outsmart customers, and they are unable to claim coverage. So even if their homes were covered by an insurance program and they have suffered financial loss or damage, they're unable to claim those insurances just because they're being denied at every step. And even when they are being provided, it is much lower than what their original plan was. And the FAIR plan is usually very manipulated by the private lawyers and private insurance providers, and they are unable to keep up with the loss. So overall, I would say the FAIR plan has had much more negative impacts and has not been able to solve the problem for what it was set out for. So let's look at some of the solutions which my colleague will be talking about. Thank you.
What solutions have been proposed? Ever since Proposition 103 was implemented, insurance companies have been trying to find ideas, resolutions, simply a way to solve the problem that has occurred due to Proposition 103. And according to Chapter 8 in our book, some of the drawbacks of prior approval law rates is that politics plays such an important role. Essentially, depending on the current politics, some rate approvals may be approved, some may not. There can be very difficult to change things depending on politics, and it is essentially so much going on based off politics. That is the case for our current scenario as well. Essentially, for any big changes for Proposition 103 to occur, 75% of legislature must agree on a change. And given the current political climate, it does not seem likely for such an agreement to occur anytime soon. So instead, people are trying to pivot more instead of completely changing Proposition 103 to maybe having a compromise in which insurers and insurees would both benefit and Proposition 103 would still be intact. One of the people who is trying to come up with a compromise is California State top insurance regulator Ricardo Lara. This compromise would essentially help out those that need insurance by basically forcing companies to write policies in areas that are prone to wildfires of at least 85% of their statewide market share. Now, it's a lot of words, it's kind of confusing, but essentially, if an insurance company insures 20 out of 100 homes, the company would also have to write 17 policies for homeowners in areas that are being threatened by wildfires. This would be very good news for homeowners in those areas because it would be a nice breath of fresh air knowing that there's a lot more likelihood of a chance of them being insured, especially with a lot of insurers currently pulling out of California. Now, this benefits the insurees. For the insurers, this compromise means that they will be able to start using forward-looking models and be able to factor in climate change for calculating their future rates. This would be huge for insurers because currently they are using backward-looking models, essentially meaning they're having to try to use the rates that have worked in the past to work for the present. However, rates do not increase in a linear fashion due to changes in population, increases in costs due to inflation, and global warming essentially making wildfires a lot more severe and a lot more frequent compared to years in the past, means that the rates in the past just are not sustainable for current day. If insurers are able to use forward-looking models, they would be able to predict and have a lot more accurate rates, which would allow them to be a lot more sustainable and be able to stay in business and insure a lot more people. Now, a lot of people are really liking this idea because this idea was proposed not too long ago. It was in September of this year, right after the legislative session ended. And essentially that means that there's going to be no more new laws passed, no more new laws proposed until the start of the new year, meaning there's a 5-month gap in which essentially nothing can be done. So this compromise is a really nice way to give hope to insurance companies for something to happen, if at all anything. Now, another possible solution that has been thrown around is the idea of mitigation. Mitigation, of course, being knowing that a risk is going to happen and essentially just trying to prevent as much of it as possible. So in this case, this would essentially mean that the homeowners in California would try to fortify their homes. They would perhaps upgrade their roofs, upgrade their windows, try to make their landscapes around their homes into a much more better way, trying to both prevent the spread of wildfires and, if a wildfire occurs, trying to just completely contain it a lot better. Now, with this, insurance companies would also provide consumers with a risk score that can be appealed. And depending on the risk score, you could get more benefits and more discounts the more mitigation factors you have. For example, if you upgrade your windows, your risk score might go up and you might get a lot more discounts on your insurance. This would also help with transparency because homeowners would know where they stand with insurance companies. If the risk score is really bad, they can improve it and appeal it, and essentially they won't have to worry as much about whether or not they will get insurance. Another possible solution is the changing land use policy. Essentially, there are areas in California called WUIs. This stands for Wildland Urban Interface. These are the areas in between unoccupied land and human development. It's the area right in the middle. And this idea would essentially be prohibit the development of anything inside the WUI. The idea would be that this would mean less human contact, so less chance of a wildfire to start. And if a wildfire does start, there would be a lot less damage and a lot less things having to cover because there would be no development in the area. A strong case for this is that similar policies are enacted for trying to handle flood insurance. Essentially, there's a lot less development in floodplains, the area right next to the river, because in the event of a flood, it very much linearly reduces the chances of human loss, house loss, and insurance costs, because there will be less people in the area affected. So on a similar note, changing the land use policy would essentially mean less people within the area of wildfires and less of a chance for wildfires to start.
Hi, this is Cesar, and I'm going to be talking about why the solutions my classmates talked about wouldn't be successful. When thinking about this issue, we must take into account the challenges faced by these new models. For example, insurers may manipulate forward-looking models to justify higher rate increases. Also, ensuring transparency in the use of such models is challenging, making it difficult for the public to understand and evaluate rate hikes. On the other hand, we have a few concerns. For example, there is a risk that factoring in the cost of reinsurance and climate change could lead to significant higher prices for homeowners, potentially making insurance hard to get for some. So why would mitigation prove to be ineffective? As explained in Chapter 3 by Dr. John, mitigation is a process that identifies loss exposures faced by an organization and selects the most appropriate technique for treating such exposures. So what seems to be the problem with mitigation? This has to do with historical ineffectiveness. Past attempts at offering discounts for mitigation efforts have shown limited success. Homeowners may not be sufficiently motivated to invest in wildfire prevention measures, even when presented with the incentive of reduced insurance premiums. On the other hand, some homeowners may underestimate the potential risk of wildfires, leading to a lack of motivation to make significant investments in mitigation efforts. Also, even with the promise of discounts, homeowners may face significant upfront costs associated with implementing mitigation measures, especially in lower income communities. Another challenge has to do with public awareness and education. Homeowners may not be fully aware of the potential benefits of mitigation or the availability of associated discounts. A lack of public awareness and education could undermine the effectiveness of the incentive program. Okay, now it's time to talk about land use policy. Is it changing it a feasible solution? Well, based on the information and data I have collected, it's not. It's not a feasible solution because prohibiting the use of waterland-urban interfaces for building is a drastic measure with potential far-reaching consequences. For example, we might face displacement and economic effects. A ban on building in walled-down urban interfaces could lead to displacement of existing communities and businesses. Also, this could result in economic hardships for those who depend on these areas, creating potential social and economic inequalities. Obstacles presented by reforming Prop 103. First of all, I would like to present to you what is meant by Proposition 103. Proposition 103 was passed in November 1998 and was intended to protect consumers from arbitrary insurance rates and practices, to encourage a competitive marketplace, and to ensure that insurance is fair, available, and affordable for all Californians. Now that we have defined Proposition 103, I want to talk about the greatest challenge that we would face if we were to reform Proposition 103. The greatest challenge is consumer resistance. Proposals to reform Proposition 103 may face opposition from consumer watchdog groups. These groups often protect the rights and interests of policyholders, and any perceived change that could be viewed as detrimental to consumers might, met, might be met with resistance. On the other hand, we have public and stakeholder skepticism. Many stakeholders, including consumers and advocacy groups, may express skepticism regarding predictive rate models. There could be concerns that these models may overstate the risk, leading to unwanted rate increases and potentially making insurance less affordable for consumers. Also, we may face difficulty in gaining public trust. Building trust in predictive rate models may be challenging, and without public confidence, any proposed reforms based on these models may face obstacles. We must also take into account that changing Proposition 103 requires at least two-thirds majority in the legislature. This high threshold for approval makes the process challenging, especially when dealing with complex and potentially controversial issues related to insurance rate regulation. Also, gaining the necessary support and coordination is a complex task that involves navigating diverse political opinions and interests. Last but not least, we have Insurance Market Action Plan, which aims to reduce financial uncertainty and make accidental loss manageable. It does this by replacing a small insurance premium with a promise to pay in the event of a large loss. However, as I have listed on this slide, consumer advocate groups may oppose the use of the Insurance Market Action Plan, arguing that it could be a mechanism favoring insurance companies over consumers. Also, the perception of unfairness in the IMAP may lead to resistance hindering the adoption of proposed reforms.
And when talking about team, I will talk about what kind of use similar tactic as a reinsurance market to be profitable. There are three reasons related to it. First is data limitation, next is underwriting perspective, finally regulatory constraint. Let's talk about data limitation. First of all, you know that primary insurers generally have less access to data than the reinsurance market. This is due to several factors. First, the reinsurance market has been around for longer than the primary market. This means they have more time to collect data about wildfire or other disaster. Second, the reason reinsurance market is global and the primary market is only focused on a certain area, which is a nation, or in this case, is a state of California. This means that the insurance market has access to wide data from around the world. Finally, the reinsurance market is willing to invest more in data collection and analyze the primary. Because of the data limitation, this leads to several problems. First is higher premium for homeowner who's in area which is severe to wildfire. And also the insurer who do not have access to this data on wildfire risk might charge higher premium for homeowners in this area. Next, I will talk about the underwriting expertise. As you know, the primary insurer generally have less underwriting expertise in pricing for wildfire risk than the reinsurance market. This is due to their specialization, longer track record, and access to more data. This expertise allows the reinsurance companies to more accurately price the wildfire risk, which can lead to lower premium for policyholders. There are also some additional factors that compute to the difference in underwriting expertise between the primary insurer and the reinsurance companies. First, the reinsurance company have a larger capital. This allows them to take on more risk, including the wildfire risk as well as other disaster risk. Next, the reinsurance companies have a global reach. This gives them access to more data from wide range of sources, including the areas around the world that is severe to wildfire or other disaster. And finally, the reinsurance company invests more in research and development, as I have told you before. Next is about the regulation constraint. The primary market is subject to more regulatory constraints than the reinsurance market. This constraint makes it really difficult for the primary insurer to implement new pricing models such as those based on the catastrophe model. As the result of those challenges, the primary market is often available to price wildfire as accurately and efficiently as the reinsurance market. This leads to a higher premium for homeowners in the area which is severe to wildfire, and it's made more difficult for the insurer to provide coverage in those areas. And in additionally to these challenges, the primary insurance market might also reluctant to use the catastrophe model to set the risk because they feel that it will lead to the adverse selection. In the adverse selection, this means that when the policyholder with higher risk are more likely to purchase the coverage, but the policyholder with lower risk are less likely to purchase it, or they might drop the coverage. This leads to a situation where the insurers only left with high risk policyholder which can drive up the premium even further, which means that the price for premium will be really high. And overall, there are a number of reasons why the primary insurance market has not been able to use the catastrophe model to set the rates in the same way as the reinsurance market. These challenges are likely to continue to pose a problem for the primary market as climate change leads to a more frequent and severe natural disaster. It will not only just stop at wildfire. And finally, let me lead to a conclusion of my. So let's talk about the conclusion. As you know, California insurance rate regulation system is facing a number of challenges in the wake of climate change. And as you can know, there's a lot of insurance companies have left the state. For example, State Farm has stopped writing new homeowner policies. And these challenges are likely to continue to grow in the years to come. And it is really crucial for the policymaker to find solutions that ensure people in California have access to affordable and reliable insurance coverage. And this is not only just stop at California, because climate change will affect the global as a whole. So more money should be put into research and development, and the insurance companies have to find out new ways to help the people anywhere to get access to adequate home insurance coverage. And thank you for your listening. This is the end of the presentation of our team. Bye bye.